Good morning, everyone. I'm your host, Joanne Jobin with VID Media, and today I am delighted to once again welcome Arizona Sonoran Copper Company. We are here this morning with CEO George Ogilvie and his team, who will discuss the company's recently announced updated PEA on the Cactus Open Pit Copper Project in Arizona. Very exciting news. Before we get started, I do want to remind you that if you have any questions for the company, and I'm sure there will be many this morning, please place them in the Q&A tab at the top, located near your chat sections. This helps us a lot as we sort through the Q&A. We will answer as many questions as possible at the end of the presentation. So George, without further ado, the stage is yours.
Thank you, Joanne, and welcome everybody. And thank you for joining us today with the Cactus project and a review of our preliminary economic assessment, which we released yesterday in a press release. So without further ado, I'd like to move through this presentation deck. We will have a Q&A session at the end and give everybody the opportunity to ask as many questions as they'd like. So if we could move on to the next slide, we do make some forward-looking statements, and I'll draw your attention to the cautionary language. This presentation is on our website, so please feel free to review the forward-looking statements at your own discretion. 3 weeks ago, obviously, we put out a mineral resource estimate, which brought Mainspring into the global resource on the first occasion. At that point in time, we published 11 billion pounds of contained copper in the ground. And as we alluded to, with Mainspring coming in as potentially an open pit, which we are now seeing within the PEA, it allows us to now look at mining Park Salyer as an open pit. And you may remember within the pre-feasibility study, that was initially designed as an underground sub-level cave. What that does for us is that it increases the production by over 50%, now taking us to 86,000 short tons of copper cathode production per annum, and increases the mine life from 21 years to 31 years. And obviously with open pit mining and lower operating costs, we can lower the cutoff grade levels. That brings more mineralized tons into the equation and significantly improves the economics of the project. I'd also like just to remind our listeners and viewers here today that when we put out the pre-feasibility study in February of this year, at that point in time, we did not have legal ownership of the Mainspring property, which we only acquired in March of this year. At the same time, we only were able to get the general plan arrangement and the permitting changed over to industrial land use at the end of March. And of course, we only drilled out Mainspring into an inferred resource in April of this year. Hence the reason why it could not be included in the pre-feasibility study. And there was also a regulatory requirement for putting out a new technical report ahead of our AIF on the 31st of March of this year. And that's the reason why we always said that the PFS was merely a stepping stone to bigger and better things. And I certainly believe today with the results that we're going to share with you, the management of the company has certainly achieved that. If we could move on, Alison, to the next slide. So with an average annual production of 86,000 short tons or 172 million pounds of copper cathode annually, you can see that we've significantly moved up the production profile, and we're now situated between Santa Cruz and the Ivanhoe Electric, immediately on our southern border, and interestingly enough, Copper World and Hud Bay, which is also another Arizona project. If you to follow this progression over the last 4 years, you'll be able to see that obviously with the initial PEA, it was 52 million pounds of annual production and 110 million pounds with the pre-feasibility study. And now we've seen a 50% uplift to 172 million pounds. Thank you, Alison. So we've ran the financial and economic model in this PEA at $3.90 copper price. We did that on the basis that the PFS was ran at $3.90, which was the long-term copper price projection in February of this year. We really wanted to show the market and the investment community that this was a true apples to apples comparison. So the NPV8 after tax now jumps to $2 billion US. The IRR after tax is now 24%, and the payback is sub 5 years at 4.9 years. And very excitedly, we see that the NPV to CapEx is actually sitting at 3 to 1. The life of mine free cash flow on an unlevered basis is sitting at around 7.3 billion US dollars. I'll also draw your attention that over the first 20 years of the mine life, the average annual production is actually 116,000 short tons of cathode production, which is 232 million pounds of copper. With the inclusion of Mainspring and allowing us to bring Park Salyer in as an open pit, we're now seeing 94% of the tons that we'll actually mine over the 31-year mine life being open pit tons. So obviously from a project execution perspective, that is going to significantly reduce the risks. And as we'll see later on when we get to the CapEx, sustaining capital, and some of the unit costs, it significantly lowers our unit costs. Thank you, Alison. So where are those tons coming from and how has the project changed? Well, obviously Park Salyer, which includes Mainspring, really is the driving force and the foundation for this business plan that we're presenting here today. In totality, including waste and mineralized tons, we will be producing 2.2 billion short tons moved over a 22-year period. Cactus West comes in years 7 to 11. That's really the oxide and the enriched material. And then we start to see some of the first primary material coming in year 15, 19, and then 23 to 31 is really principally the primary sulfide at a very low recovery rate. So 605 million tons in total there. Cactus East remains an underground sublevel cave between years 8 and 21 with 42 million short tons mined. And here you'll see as well the surface stockpile is being mined, but not to the same degree as the pre-feasibility study. In this current business plan, we only envisage mining 10 million short tons in year 1, essentially to help us with the commissioning of the plant. Thank you, Alison. So 172 million pounds of annual copper production. That equates to 889 million short tons of mineralized material. Where are those tons coming from? Well, 659 million tons will come from oxide and enriched material, which is around 75% of the overall tons. And 230 million tons will come from primary sulfide, which is the remaining 25%. If we break those down, you can see almost 70% of the oxide enriched material comes from Park Salyer, 23% from Cactus East, and a lesser extent from Cactus East and the surface stockpile. And then with respect to the primary, you can see the bulk of the material, 2/3, comes from Cactus West, where we're still drilling today with some of the Newton monies that have been invested and finding more primary mineralization outside of the existing pit shells. Processing costs, the capital has increased to 511 million, including contingency. There'll be 553 million in sustaining capital. And at the end of the day, with a significant increase in placed tons on the leaching pad, we're looking at around $2.29 a short ton. Other costs that were impacted were obviously salvage costs, land sales, closure, and royalties. And then from the mining perspective, and we'll get into these costs in more detail later, initial capital is 157 million, which includes contingency, with sustaining capital over the 30-year mine life of 544 million. and it works out at an operating cost of around $8.16 a short ton processed. Thank you, Alison. So with this plan that we're presenting today, if we look at the top 10 producers currently in the United States, if we can execute on this plan and produce 172 million pounds of copper annually, it would place the Cactus project at number 5 within the current top 10 producers in the US. So obviously this is going to have a significant positive benefit to the copper supply chain over the next several decades within the United States. This will be a generational mine, and over time we do believe we will find additional mineralization on our project site. Thank you, Alison. So some of the further highlights with respect to the overall strip ratio, with 889 million tons of mineralized material being mined, the strip ratio for the entire project is 2.3 to 1. That is broken out with 3.2 waste tons to 1 ton of mineralized material at Park Salyer, and Cactus West is a 1-to-1 ratio, so very, very manageable. The head grade delivered to the leaching pads is 0.41 total soluble copper, and you'll notice that the recoveries for oxide and enriched material remain the same as what we published in the pre-feasibility study, and those are supported with 3.5 years of metallurgical work. Because the mine's latter years, principally the last 7 to 8 years of the mine life, is predominantly primary sulfide, where we've went with a very conservative recovery of 25%, it brings the overall recovery down to 73%. But there's huge potential there. Obviously, if Newton can prove successful, we would see those primary recoveries increase significantly. Life of mine cathode is 2.7 million tons, equating to 5.4 billion pounds of copper. And on an annual basis, we'll be placing about 29 million tons of mineralized material onto the leaching pads, which equates to about 80,000 tons of material being moved on a daily basis. Thank you, Alison. So here you can see the bars represent the various assets that we have and when they will be mined in the cycle. This is obviously a big change from what we had in the PFS, where there was a principal focus on Cactus West. Obviously, with Mainspring and Park Salyer now being a larger open pit, the first 10 years of the mine life really focuses in on Park Salyer. And you'll see that there's significant cash flows that ultimately are going to be generated in years 5, 6, and 7 of the project once we look at the revenue and the cash flow slides. Over the first 10 years, you can see that there's about 1.6 billion pounds of copper actually produced in the first 10 years of the project. Thank you, Alison. So here you can look at the EBITDA, the revenue we generate, and the free cash flow. On average, over the 31 years mine life, we'd be generating $670 million of annual revenue using a copper price of $3.90 a pound. In totality, that gives us about $21 billion US of revenue. And as we stated earlier, on an unlevered after-tax basis, we're looking at $7.3 billion in free cash flow. So when we started putting the financial and economic study together some 3 to 4 months ago, we thought $3.90 was a very conservative copper price. Obviously, we didn't reckon on the copper price falling below $4 as it's did in the last couple of days. But I'd like to draw your attention on this sensitivity slide to $3.50 a pound of copper. Even at $3.50, we have an NPV after tax 8% discount factor of $1.4 billion US and an IRR after tax of 20%. And you can see that the free cash flow on an unlevered basis is still $5.5 billion US. Those numbers are superior to the pre-feasibility study that went out in February of this year at $3.50 a pound of copper. We all know as well that in the last 3 months with the short squeeze on COMEX, we did see $5 a pound of copper. If we look at this project at $5 a pound copper, the NPV after tax would be 3.7 billion US. The IRR is 35%, and the free cash flow is almost 12 billion US dollars. Every 50-cent increment in copper price generates an additional $700 million to the NPV of the project. So it's very sensitive to the copper price, which gives investors huge torque in a rising copper price environment, which we expect to see in the next several years, despite the short-term weakness in the market. Thank you. So what next? Well, obviously the metallurgical testing is ongoing, particularly for Mainspring, which is not currently at pre-feasibility study level. The columns have started up, and before the summer of next year, we expect those columns to have been drawn down, and they will be input into the pre-feasibility study. There's obviously further infill drilling at Mainspring that's going to be required to move the inferred resource up into measured and indicated, while with the investment from Newton, we are currently drilling at Cactus West to add and find additional primary sulfide material. We anticipate initiating a pre-feasibility study within the next several weeks. That would be completed by the summer of 2025, and that's when Newton will come into that integrated pre-feasibility study. By the end of 2025, we would envisage producing a definitive feasibility study, and between now and then, we will be in discussions with potential project financiers. To be very clear, we don't intend to do the project financing on this project until we have a definitive feasibility study in hand and can make a financial investment decision. The current PEA, like the PFS, is showing an 18 to 24-month construction and development period. And if we can make that decision early in 2026, then we have the ability to see first cathode here before the end of 2027 or early 2028, which is a relatively short period of time for first cathode production with respect to any copper project today in the world. Thank you, Alison. So now we're going to move on to the production slides, and I'd like to introduce Bernie Lawyer, who will talk to these slides. He is our Senior VP of Projects. Bernie, over to you.
Right. Thanks, George. And good morning, everyone. So as George has already highlighted, most of the operation is now open pit. And with a remaining about approximately 5% that would be from an underground source, as we know as Cactus East. And we sort of knew that had the potential for being the case back in August of 2023, just based upon some legacy drill data that we had south of our indicated resource of Park Salyer. So on the basis, and we did at that point in time have a pathway towards ownership. So with agreement with that previous owner, we started drilling, and of course, progressively we came to understand that in fact it would interface to Park Salyer in such a manner that it would become open pit. And as George pointed out, it just came in later, post PFS that was actually posted to CDAR in March. So for a lot of people, it looks like, well, in just a brief 3 or 4 months, you've changed the book completely. But in reality, that story started back in early September of 2023. So this graphic here sort of portrays operating cost against a background of recovered copper over a 31-year life. I'm predominantly I have a background as an operator, and we like that copper recovery to be as flat as possible, but it just doesn't really work like that in the real world. And so what we have reflected in this graphic is, because the tonnage, the throughput rate to the facility, for the most part, is flat, with the exception of about year, I think it's 8 or 9, we bump up to from 24 million to 31 million tons per annum. What the variable is, of course, is grade. And we know as we get deeper into Park Cellular, that grade improves. And at year 15, as represented on this graph, we begin to see a transition to hypogene material at a rate of 7.3 million tons per annum, not in addition to the 31, but in supplement of enriched material. And that at one point actually ramps up to about an addition of 24 million tons per annum. So we can see the C1 cost at $1.82 and all-in sustaining at $2. The open pit initiates at Park Cellular, in addition to the introduction of tonnage from the historical stockpile. And of course, as precursor to all of that, we actually start pre-stripping to the tune of about 70 million tons, which happens coincident, or at least a large fraction of it, with the 18-month to 24-month build that George was referring to. So, we've talked a little bit about grade and some of the variability that we have. Overall, it's good grade. When we transition to Park Cellular, and maybe it's worth noting that Park Cellular was obviously the heart of the asset, even with the PFS. But of course, that just became exponentially more the case once it transitioned from that underground at 100 million tons to an open pit at now pushing almost 600 million tons. Metallurgical recoveries overall for the asset, total copper, the study reflects 73%, and it's based upon overall about 4 years of test work, and that test work is ongoing and will continue so for the next 18 months in preparation for the next study. 92% for oxide, 85% for enriched, and as we've mentioned, at about year 15, begin to progressively ramp up the introduction of hypogene material, and we've got that currently represented at 25%. We've got test work that validates values much higher than that 25, but we've been modest in the assumption. We've got additional test work going on right now at one of the labs in Tucson to validate further that 25% plus. And next slide, Allison. So these next series of slides essentially just lead us through from a plan view and 10,000 feet what's really going to be happening on the site. Sort of upper center, you see what we call the original Sacaton pit that we refer to now as Cactus West, and then to its lower left is the Park Cellular deposit. So as we've already mentioned, the mine production schedule initially focuses on Park Cellular with phase 1, 2, and 3, and of course 10 million tons of feed from the historical stockpile. That all initiates in year 1. Of course, previous to that, we've begun the stripping exercise of 70 million tons that I've already mentioned. And we've got a target throughput rate of 24 million tons. That's not big, pretty manageable in today's world from a throughput point of view. And then a peak mining rate, considering the stripping ratio that George was referring to in years 2, 4, and 5 of about 150 million tons. Feed material during that period is 0.2 to 0.95 total copper. And next slide there, Allison. And then 6 to 10, again, the saga continues, predominantly Park Cellular. Now we're really beginning to get into some really good material. As we work phase 2 through phase 5, and then Cactus West starts in year 7 with phase 1. The uniqueness of Cactus West, of course, is the strip ratio is essentially zip. It is lower grade, but really accessible. During that period, of course, we begin, I think it's in year 8, with the development work into our yet remaining underground Cactus East at 42 million tons in 0.8. So it really delivered value in the PFS. It will really deliver value here, yet it remains 5% of the total inventory asset as we know it today. And as George mentions, the drilling continues at Cactus West, and we'll see what that delivers over the coming months. So I think we can go on to the next slide. Okay, so 11 through 15. This is sort of the era of when we're fully into Cactus West. It is now up to its average throughput of 3 to 3.5 million tons per annum. In conjunction, we're working our way from phase 3 to phase 6 in Park Cellular. Phase 7, as we'll find, is really the opening of hypogene material, with essentially all of the strip associated with getting there out of the way. So feed material continues at 31 million tons per annum until year 15. And at that point, hypogene starts coming in. And that's where, at a progressively increasing rate, and that is where we have factored in the 25% recovery. But I am confident, based upon the additional test work that's ongoing now, that number will increase. And then 16 through 20, now we're finally starting to move into phase 7. Cactus West continuing to mine at phase 1. So, what that means almost subliminally is we've got 2 pits running at the same time, and which, they're immediately adjacent to one another. So we think from a logistical point of view, pretty manageable. Feed material during that period from 0.4 to 0.9. Next slide. And then, of course, the balance of life of mine remaining, coincidentally, or, in parallel, we're mining from Park Cellular, Cactus West, and Cactus East. And Park Cellular actually completes in year 22. Mining in Cactus West continues with phase 1 and phase 2 until completion in year 31. And that range of grade is 0.14 through 0.46. Here's a bit of a snapshot of what our sublevel cave at Cactus East looks like. And some of this was portrayed in the earlier study. Not a lot has changed. A conventional decline with vertical conveyance, and a sublevel cave that'll run from years 8 through 21. So here we'll toggle into cost a little bit, and the little hard to see, but at least from my end, we've got a post-tax NPV of 2.03 billion, and a post-tax IRR of 24%, and a payback period of 4.9 years. Project metrics, a construction time as outlined by George, specific to the SXEW plant, of about 18 months to 2 years. That's pretty defensible. based upon other similar projects that have gone on over the years. We have to decide at what point we start that 70 million tons of pre-strip and how parallel or overlap that will be with that 18-month to 24-month build time. Life of mine 31 years, strip ratio on average of 2.23 across the asset, and pushing 900 million tons of mineralized material. Life of mine SXEW throughput 29 million tons. It's a big facility. It'll start out at 60,000 tons per annum, and I think it's in year 4. We actually double that capacity to 120. Next slide. So here's some of the cost breakdown in terms of the process plant. As an example, mine operating cost at $8.16, as George noted, per ton processed, with a process plant operating cost of $2.29, and royalties are noted at 0.44 per short ton processed. Sustaining capital at $1.31 per ton processed, and all-in cost at 13.42 per short ton processed. So here we take a look at free cash flow, assuming $2.90 a pound mine. And you can see that, as we've talked about, we sort of move into positive territory as we approach year 5, and ultimately land on about 7.3, 7.4 billion pounds or $1 billion of free cash flow over the 31-year life cycle of the asset. So I think Nick is going to speak to this.
I am. Thank you, Bernie. And good morning, everyone. We realize one of the questions that folks will be with respect to our ability to finance this project. But we did want to point out that we were extremely pleased with the NPV to CapEx ratio of 3 times. As you all know, anything over 1 times would be a very good result. And in our particular case, we're delivering 3 times the value for every development dollar that we put into the ground. And that clearly was a function of the resequencing of Parks failure and Mainspring into the early parts of the mine life. As George pointed out, we demonstrated a strong IRR of 24%. And we're also showing that we've got robust cash flows of $2 billion in years 1 to 10 at a $3.90 copper price. And the reason why that's important is that'll be a focal point for lenders. And because those cash flows are so robust, we do believe that the project is going to be meaningful, and we believe it'll attract the interest of global lenders to the mining space. It is a long life asset. As George pointed out, we believe we produced a generational asset of plus 30 years of life of mine cash flows of $7.3 billion. What does that mean from a financing standpoint? What it means is it gives the lenders comfort that their loan will be repaid because of the long life nature of the asset. And again, we're assuming 390 metal. If the pundits are right, and we see a bullish copper price going into the next few years or so, obviously those cash flows will be even more robust than they are at the current time. We do believe that the economics provide a strong platform for financing. We will commence those activities very shortly. Our goal is to produce a fully financed project by the time we complete a definitive feasibility study. And so we are going to take a very proactive approach and ensure that we're in a good stead with respect to that goal. In terms of the financing opportunities, we do believe that this project will be appealing to the traditional project finance institutions, the export credit agencies, and offtake providers. Our management team has a lot of experience with these groups, and we look forward to working with these groups to get a good result for our shareholders and for them as new stakeholders.
Thank you, Nick, and thank you, Bernie. So with respect to the social license, obviously we maintain a very strong social license, both within the community of Casa Grande and Pinal County. I can advise you here over the last 6 months, as we saw these results coming together, we have been in dialogue with the regulators and with the local community so that nobody was caught off guard. And everybody is going to be very supportive of this plan that we're presenting here today. We are obviously wanting to protect the water source. You may remember we have water rights to the year 2070, an abundance of water literally in the ground below our feet. We're dedicated to cleaning up the site. This was a liability, this Sacaton mine, to the Arizona taxpayer. And through this business plan and ultimately putting this mine into production, we will be cleaning up some of those legacy issues that were left behind by former operators. It's a generational mine. And on the pre-feasibility study that we put out, we did an internal economic study, and we were generating about $8 billion of economic activity from that PFS. And I suspect with 50+% uplift in cathode production and an additional 10 years of mine life, those numbers are only going to increase exponentially. So I think this is a great outcome, not just for the shareholders of the company, but also for the stakeholders and the community in and around the mine and Arizona in general. Thank you, Alison. We have completed several perception surveys. The last one was conducted in December 2021. I can tell you that we're in the process of arranging for a new perception survey that I would anticipate we'll have in hand early in 2025. But we do see very strong support for the project, in excess of 80% from 500 respondents. And you'll notice from the demographics with respect to political parties, even 67% of Democrats were in favor of seeing this mine coming back into production. Thank you, Alison. With respect to the permitting is not going to change with this enlarged business plan. You'll see on the next slide, we've already made application for an amendment to the permits on the aquifer protection permit and also for the industrial air permit. That is as per the pre-feasibility study that came to the market in February of this year. We would anticipate late this year, early next year, we will have those amended permits in hand. And as we get closer to the conclusion of the pre-feasibility study in the summer of 2025, we will then reapply for further amendments to all of our permits. We've been in dialogue with the regulators, and they would rather that we put these amended permits in on a regular basis. It keeps us in close contact with the regulators so that they're not blindsided by any significant change to the plan. And obviously, we believe that this is beneficial as well, and it keeps the market up to date on the permitting process on a regular, consistent basis. Thank you, Alison. And then, as I alluded to, the aquifer protection permit and the industrial air permit, as per the pre-feasibility study, is now underway, and those amendments have been submitted. So let's look at some valuation metrics. And I think over the next 3 to 4 slides that we're going to present, I think the biggest takeaway that you should be looking for is that the company is significantly undervalued. And if anybody's looking at potentially an entry point for an investment into the company, I would certainly say that this is an ideal point in time, given the metrics that we're about to show. So at the moment, we believe that we're trading on a PNAV multiple of 0.3 times. Obviously, this is a PEA, but it is built substantially from a pre-feasibility study. I think if you look at the global resource now of 11 billion pounds of contained copper, it stacks up very favorably with a lot of our immediate peers. And certainly as far as the capital intensity is concerned, it's the lowest project. And I would also say that the economics are extremely robust. And of course, all of this is based on a copper price of $3.90 a pound of copper. Thank you, Alison. Another metric, if we look at the enterprise value per measured and indicated resource sitting in the ground today, we are currently trading at under 2 cents measured and indicated resource in the ground. Whereas if we look at our peer average, that would be around 9.5 cents a pound of copper in the ground. Even the median of around 2.5 cents would indicate that there should be a significant uplift in the valuation of Arizona Sonora's share price. Thank you, Alison. We touched on this earlier, but 0.3 times price to NAV. If we look at our peers and those that are at PEA level, you can see they're trading at 0.38 times, and those at PFS are at 0.48 times. So again, significant opportunity for uplift as these results are disseminated into the market and the management gets the opportunity to communicate over the next 2 to 3 months the implication of these results. We believe there's going to be a re-rate in the company's share price prior to the end of the calendar year. And then if we look at the enterprise value of the company, 105 million with 172 million pounds of annual production over 31 years. Obviously, that takes us beyond the production profiles of companies like Sacaton and Alitalia and Imperial Metals. I'm not suggesting in any way that we're going to get a producer multiple and re-rate tomorrow, but for those who are long copper and believe in the long-term fundamentals of a more robust copper environment, I think the opportunity for a significant re-rate is extremely high. Thank you, Alison. We touched on this earlier, but capital intensity is around 9,000 US dollars a short ton. That puts us in the lowest quartile as far as our peers are concerned. And then on the next slide, we just re-emphasize that. But obviously you can see that as far as the life of mine is concerned, 31 years again is certainly right up there at the top end of the scale. Thank you, Alison. And then as Nick touched on, obviously we want the NPV to CapEx ratio to be above 1. In the pre-feasibility study, this was 1-to-1. And right now we're showing the number at 3-to-1. And the next slide basically emphasizes why that is the case. So we're on flat land. Obviously, we are very close to public highways. We have a rail line immediately on our southern border. There's a main power line that runs right through the site. The city of Casa Grande today has a population of almost 70,000 people and is within 5 kilometers of the mine site. There's no requirement to put in roads, power lines. We have water in the ground. We don't have to build a desalination plant and pump water, thousands of, kilometers in from the coast to 4,000-5,000 meter elevation. We're in a very unique and fortunate situation that we have world-class infrastructure immediately on our doorstep, and we have a very strong social license from the local community. And that's one of the reasons why the CapEx intensity on this project is significantly low. Thank you, Alison. Future opportunities. So one of the things that we will be considering when we move into the pre-feasibility study will be in-pit crushing and conveying. Everything at the moment within the production plan we've presented is based on shovels in the open pit and moving the tonnage from the pit to the crushing plant via 300-ton capacity trucks. Obviously, we want to consider the social impact, and obviously dust and noise is going to be part of that. And we think that in-pit crushing and conveying can assist with that, as well as improving the economics of the project. The current plan starts in the furthest southern position of Mainspring because of the close mineralization within 42 meters of surface. However, if we were to move the centroid of the open pit a little bit further north, it would increase the pre-stripping in the mine's early years, but it would allow us to get into the super high grade of Park Salia, which is the 0.5% up to 1% copper, 1 to 2 years earlier, and therefore bring forward some of those very robust cash flows that we were showing on some of the previous slides. We think that could be hugely beneficial to the economics of the project. As we alluded to, there is no Nuton in this plan. It's a pure standalone business case. And for those reasons, we're only showing 25% recovery of the primary sulfide. We do expect that when we bring Nuton into the equation with the pre-feasibility study in the summer of next year, that those recoveries are going to substantially increase and it will be accretive to the project. I believe we will find additional mineralization through exploration on the site. However, to be very clear, with 11 billion pounds of contained copper in the ground, I don't see exploration as our focus over the next couple of years from a standalone business case. Our focus has to be on infill drilling and moving Mainspring into M&I ahead of that PFS in the summer of next year, and then the definitive feasibility study at the end of 2025. Thank you, Alison. So look, a little bit on Nuton. When we entered into the option to joint venture, it was based on a pre-feasibility study. Within the PEA, when we looked at Nuton, it was adding value to the project. It was accretive, but the biggest challenge we have at the moment with Nuton is that the primary sulfide only comes into the equation in and around year 15. So based on the time value of money, when we run these discounted cash flow models, it obviously was not so accretive for the Nuton process. So we've decided to move forward with Nuton, bring this into the pre-feasibility study. As I said earlier, we do have a couple of drills drilling primary sulfide material out right now, currently outside of the resource pit shell. And we're very confident that we can bring Nuton into the pre-feasibility study, where it will add significant accretion to the project. Thank you, Alison. So final slide. We believe this is a quality project. It's a large copper porphyry system. You've got a management team here with a proven track record of delivering exceptional results for shareholders of the company. This is a tier 1 jurisdiction. There's huge future opportunities where we can further improve the economics of the project. It's a generational mine now with a 30+ year mine life. The economics are extremely robust at what I believe is a conservative copper price when you start to consider the medium and longer term fundamentals for the copper market in general. It's a low risk project given it's significantly permitted. It's a brownfield site, low capital, and we have a very strong social license. So with that, I'll stop there. Joanne, I'll hand back to yourself and we can open up the floor for a Q&A session.
Thank you very much, George. Again, a fantastic update as per usual. We have another amazing full house of participants in the room today. Well done, everyone. Thank you so much for tuning in. And now we will take questions from the audience. Again, it's just a reminder to place your Q&A in the tab located near the top of the chat section. And I will remind everyone that we have already answered many of your questions today in this very fulsome presentation, or Allison has reached out to you directly during the presentation or will be reaching out to you directly to answer your question. So the first question of the day is, and of course, right out of the gate, how does the recent leach pad failure in the Yukon factor into the current thinking on your pad design, George?
Well, certainly we don't like to see, those type of failures. There's obviously been a couple in the last, 6 months and over the years. So certainly when we go to the engineering and the design work, we'll certainly be making sure that we build in the appropriate levels, safety factor levels. I think one advantage we do have is that we are in an industrial park and we're on extremely flat lying surfaces. Some of the most recent failures have been on or very close to inclined surfaces, which can obviously destabilize the leaching pad. The other, sort of benefit we have is that we are in a very dry, arid area that doesn't get exposed to a lot of rainfall, which can, again, destabilize the leach pad. But in saying that, you do get occasional 1 in 100-year events where you can get a lot of rain in a very short period of time. But I'd like to assure the listeners and the viewers today that we will absolutely be over-designing those pads to ensure that they have the appropriate factors of safety so that doesn't occur on our property.
Thank you, George. Next question is, how did you achieve this boost in NPV and IRR?
Well, when we put out the pre-feasibility study, as we touched on earlier, at that point in time, we were unable to include Mainspring within the business plan because we didn't have legal title to Mainspring, and nor did we have it drilled out at least into an inferred resource. When all of that occurred by the end of April of this year, we were then able to bring Mainspring into the mine plan. And because Mainspring extends about 900 meters south of Park Salyer, and the mineralization comes very close to surface at its southern extent, it allows us to mine Mainspring as an economically viable open pit. And we're currently running our pit shells using a $3.75 copper price. Because we can mine Mainspring as an open pit and take it all the way down to 300 to 400 meters vertically below surface, once we move it to the north, it then takes us right into Park Salyer, which in the pre-feasibility study, in order to get down to those depths, we had to put in 2 twin declines and mine it as an underground sub-level cave, because the strip ratio with the waste that we would have had to have moved would have made it uneconomical as an open pit. But because we can now get down there with Mainspring that basically buys and pays for itself, suddenly Park Salyer can be mined as an open pit with lower cutoff grades because your mining costs are sub $3 a ton versus $27 a ton, which was the mining cost in the pre-feasibility study. And suddenly now you're looking at much larger economies of scale, and it really is about moving tons. And that is what really has allowed us to increase the tonnage significantly, the pounds of metal, because there's much, much higher grade at Park Salyer, which we're bringing in the first 10 years. It increases the revenue and all of the free cash flow, which then allows us to pay for those CapEx numbers despite them rising. And that's why the economics increased exponentially over and above the PFS that went out 5 months ago.
Excellent. Next question has to do with strip ratio. Do you have any preliminary idea on the strip ratio or any sweet spot starting area?
Well, maybe with this one, Joanne, I'll ask either Bernie or Steve to jump in here, and they can talk more specifically to the production plan.
Yeah, Steve, do you want to speak to that, or?
Sure. As George mentioned, mainspring is a big driver on this, and it's because the shallow depth that we have, and that's where the stripping comes into. And so because we can get into the ore body with stripping, and compared to where we were at in Park Cellular, it's going to make this operation an open pit. One interesting point to be made is 87% of the mine waste is Gila conglomerate, which is full of calcite called caliche, and there will be no acid generation issue on this property. So I hope that answers your question.
Yeah, Steve, I think it's of merit to point out that, the question regarding, where's the sweet spot in terms of lowermost strip ratio, if we were to answer that without consideration of grade, it would clearly be Cactus West, right? But
yes.
And we tried that. We took a look at that in terms of sequencing before Park Cellular had the potential to become an open pit. But once that transition was complete, because of our increased knowledge with respect to mainspring and how it interfaces to Park Cellular, paying the penalty of 70 million tons of stripping up front is small price to pay in order to get into the higher grade Park Cellular ore body.
Yeah, it comes down to obtaining the highest value for every ton moved or waste. Going into mainspring gave you the best economic value.
And that's why there's a big opportunity, as we touched on in the future opportunities, that if we move the starter open pit at mainspring a little bit further north, it does increase the strip ratio, but it allows us to get into that super high grade at Park Cellular 1 to 2 years earlier. And if you can bring those revenues and high free cash flows forward, it should have positive implications for future studies.
Thank you. Thank you, gentlemen. George, there seems to be a lot of questions about space. Do you have enough room for expansion, for heaps, waste, etc.? Maybe you can talk to that in general terms.
Yeah, it's a great question, Joanne. So one of the changes in this plan is that from the PFS, our stack height with the leaching pad was approximately 125 feet to the top of the pad. With this plan, because we're significantly increasing the tons, we're going up to a design height on the leaching pads of 250 feet, which allows us to, further optimize the land package that we have. Within the 900 million tons that we intend to leach, close to 700 million tons of that can be accommodated on all of our existing land package. There's just over 200 million tons that we're currently envisage would go on to additional land. And within the current PEA, this plan that we're presenting, we have capital or sustaining capital dollars allocated for additional land. But bear in mind that isn't required on day one of the project. That is much further down the line. The other key thing to note here, and I think it is actually an opportunity, is that we are not doing any in-pit filling of the two open pits that we intend to mine, both Park Cellular and Cactus West, because they sort of overlap one another. Because Park Cellular will be relatively large, once you've advanced the open pit far enough north, you might be able to infill the pit and the southern extremities. And if you mined the open pits one after the other, and let's say you mine Park Cellular first and then you jumped over to Cactus West, while you're mining Cactus West, any waste material you have could be filling the void that you've created at Park Cellular. So in a nutshell, I think what we're saying is with future studies, there's definitely opportunity to further optimize the plan, and we may not require additional land with the infit filling options that I've just outlined on today's call.
Excellent. Thank you, George. Lots of questions on the permitting side, of course. Someone is saying Resolution Copper tends to be the poster boy for permitting delays. And how different are you in the eyes of the permitting regulators? What makes your project so different?
Well, we've discussed this on previous calls, and obviously it's important, but you have to remember we are on private land, and there is no federal nexus when it comes to any of the permits that we require. So we're only dealing with the local municipality, the county, and the regulators within the state regulators within Arizona, who all are very supportive of the project. And every permit that we have gained to date, we've always gained the permit within 6 months of making the application. And I don't expect that to change as we go forward with the project. And you also have to remember that we acquired this asset from a state environmental trust that was being managed by the Arizona Department of Environment and Quality and the Arizona State Lands Department, which are two of the main regulators for our current permits and those that we will require when we go forward. And I can assure you, they didn't sell us the asset in late 2019 to see it fail and be held up in permitting. Arizona, the state, recognizes that they've taken a few black eyes with permitting on other projects, which principally has been due to federal agencies. They really have an opportunity here to show the investment community that under the right conditions, projects can be permitted in a very short period of time. And Arizona is absolutely open for business when it comes to copper mining. It's one of the 5 C's and is one of the main economic drivers of the economy within Arizona. And I think that is only going to increase with the supply and demand fundamentals, particularly for copper cathode, which is going to remain in the US for US domestic consumption.
Excellent. Thank you, George. So lots of questions about the state of your treasury right now and what you're going to need for financing for the future.
Well, right now we have just over 10 million US dollars cash in the bank. So the treasury is extremely strong. We will have to raise monies, I would suspect, sometime before the end of this calendar year. But with that, the market should not expect an equity financing. The management team of this company brought in 33 million US dollars last year with the Newton option to JV, which was non-dilutive, non-equity. And I can tell people on this call today that we have options on the table for raising money that is non-dilutive, non-equity today. So do not expect we're coming to the market with an equity raise at these extremely low share prices.
Excellent. Thank you, George. Can you provide some color on the expectations of further improvements you have on pit crushing, conveying, and the open pit Centroid North?
Yep, maybe I'll hand over that question to Bernie or Steve if they'd like to jump in there.
Yeah, I'll start off and Steve can correct me, but could you repeat the question again, please?
Oh, shoot. I put it into archive. Hang on. Give me a second. Let me find
Bernie,
it.
I think it was.
Here we go.
Yeah,
I've got it here, George.
Okay.
Can you provide some color on the expectations of further improvements you have in areas of pit crushing, conveying, and moving the Park Salyer open pit Central North?
Okay, so I'll start. And so the IPCC, or in-pit crush convey, starts off as a near pit crush convey because we recognize that there's real benefits, not only in terms of cost per ton moved, but in terms of environmental impact, specifically in the realm of dust generation, to get it onto a conveyor versus truck. So we've done enough study to realize what the cost implication is, and it fits from an economic point of view. But we didn't feel like it was the right time to roll it in because we have another study coming, and we had a robust case using trucks. So we will take a look at the in-pit crush convey, very similar to what part of our team, myself included, put into Penasquito, which was one of the world's largest at about 10,000 tons an hour. This system would have 2 branches and would allow us to move all those waste tons that we were talking about earlier in the meeting, use it with installed conveyor system and stacking system versus trucks. So, and then the other one with respect to shifting the center line north of the Park Cellular Pit, that is a development that came in right at the last and was an iteration of an earlier mine plan that offered some real benefits, but we didn't need it. And we told our leadership, look, we'll complete peeling that onion back a little bit later with the next study. But essentially all it does is it shifts the vertical center line of that pit to the north and creates some real logistical benefits, as well as, per what George points out, it gets us into higher grades sooner. There's a bit of a penalty associated with a bit higher strip, but we'll just do a bit of a trade-off there to recognize clearly what that trade-off looks like in terms of benefit and cost. Steve, anything you want to add to any of that?
No, you're on
Really
mute, Steve.
help.
Yeah, there you go.
Okay, Mike's okay.
You can have the next.
The benefit of the IPCC is going to be matched with that moving of the centroid. And if you look at our sensitivities, operating cost is more sensitive to operating costs than, say, capital. So we need to go and drive that operating cost for mining as well as possible. And it's going to help both of those things. We'll go and evaluate these in the next level of study.
Thank you, gentlemen. George, do you see any byproducts from the current, your current product? Are you looking at, capitalizing on any byproducts, if there are anything there, or if there is anything there?
Well, it's a great question, Joanne. Within this copper porphyry system, we do have a little bit of gold and silver, which was actually recovered by ASARCO when they mined the Sacaton mine way back in the 1970s and early 1980s. Of course, at that point in time, they had a traditional copper flotation mill and were producing a concentrate. If we were ever to consider that as a business case and look at putting in a standard flotation mill to deal with the sulfides in general, that would certainly open up an opportunity for recovering some of the gold and the silver in the system. And also importantly today, there's actually molybdenum or moly in this system. ASARCO never put in a moly circuit, so it all went into the old tailings pond, which is currently a dry stack tailings facility on site. But certainly if we were to look at a traditional flotation mill, those type of revenue streams could come into the equation as a byproduct, which is going to only improve the economics further over and above what we're presenting here today.
Excellent. And the next question is, I guess the way I would put it is, what keeps you up at night? What risks remain, and that you may not meet your target dates for?
Well, from my side, I think this is a project that has significantly few risks. So really, there's nothing that keeps me up awake at night on this project. The one thing, obviously, is we can't control the external environment. And obviously, we've seen, copper inventories rising significantly throughout the world, particularly in Asia. It's put some pressure short-term on the copper price. But I believe those are short-term challenges. And if you believe in the drive for decarbonization and green energy, then I still believe that the demand for copper is going to rise exponentially over the medium and longer term. And, obviously, we're not looking to do project financing on this project today, but in 18 plus or so months' time, we would hope to be at a point in time with a definitive feasibility study. And if the external environment cooperates, we would look to make a positive financial investment decision on the basis of that. But it's something that we can't control. But I don't see us doing major project financing at this stage with a share price well below $2 a pound, $2 a share price.
Okay, excellent. And I've left the best question for last. So with the low capital intensity and significant copper production, is there a possibility for an even higher NPV? And have you looked at optimizing the mine life and production to elevate it?
Joanne, I would say absolutely. I mean, obviously, the one low-hanging fruit that we haven't sort of touched on is obviously the long-term copper price. As I said earlier, we chose $3.90 because we wanted to show the market a true apples-to-apples comparison with the PFS. But the long-term copper price today, despite the pressure on the spot price, is actually showing at $4.15 a pound of copper. And as I alluded to earlier, every 50 cents a pound of copper increase, it generates an additional $700 million to the NPV. So 25 cents would give us an extra $350 million on top of, the $2 billion that we just put out if we were using $4.15. So that's obviously a low-hanging fruit. But I think, with all the things that Bernie raised and Steve with the in-pit crushing and conveying, the in-pit filling with the waste material that we have and not requiring any additional land, I do think that, along with Newton and potentially looking at, a standard flotation mill to deal with those sulfides, can improve the economics of the project as we move forward. As you know, I'm always a realist as well, and I like to state the facts. We will see cost pressures as we move forward from a PEA to a PFS to a definitive feasibility study. Every project in the world sees that, but I think we've got a lot of bells and whistles and levers that we can pull here, and the economics at the end of the day are going to improve, and this project is absolutely going into production as on a standalone business case.
Excellent. And approximately how much drilling cost per meters are going to be needed to convert all of the inferred to measured M&I, obviously, for the mid-2025 PFS?
Maybe I'll have Bernie jump in there and give us some indication. We are working on budgets right now for calendar 2025. So, Bernie, can you give us more on that?
Yeah, it's 85,000 feet, George, and that's what we call the Priority 1 program, and that gets us to indicated because, as we all know, Park Cellular is already at indicated. So that is what transitions the mainspring southernmost extension of Park Cellular into indicated. So 85,000 feet.
And everybody should know on the call, it's $75 a foot as our direct drilling cost. So that equates to about $6.5 million US to do 85,000 feet of drilling.
Excellent. Well, it is well past the top of the hour. We extended this town hall today because we knew that this was incredibly important news. and that there would be a lot of Q&A, which there was, and a super full house. And there's still a ton of people in the room. So thank you very much for those of you who stayed to the very end and kept tuning in. Before we go, George, as always, I always ask everyone if they'd like to say a few words to the shareholders and audience members who've joined us here today.
Yeah, I'd just like to thank everybody for giving us your valuable time and dialing into the call and following the company. As I've said before, if you are considering an investment in the copper space, there can't be many lower risk copper development projects than Arizona Sonora Copper. And I believe this is an incredible investment and a great opportunity and time to invest in a very, very solid company and management team in a very safe jurisdiction. And for those that have invested or are considering investment, I believe over the course of the next several quarters and several years, you are going to see a significant return on your investment in this project, in this company.
Thank you very much, George. And thank you to Arizona Sonoran for joining us today. And just a reminder to everyone who's still here, please fill out the quick questionnaire before logging off. It really helps us and the company to communicate more effectively with you in the future. And just a reminder that this presentation will be available on the company's website and across all of our VID social media platforms within the next 12 hours. Should you have any more questions for the company, please email them directly to Allison Dwoskin at adwoskin@arizonasonoran.com. Thanks everyone who joined us today, and we look forward to seeing you on the next Town Hall Forum. Good day.